What's been very important is finding the right opportunities for our investors. And the diversity of the Gloin universe has always allowed us to allocate capital to the best opportunities. In the past, we've had periods where we invested significantly in UK water, we've benefited from the growth in mobile communications, or from the strong growth in pipelines in the US. Today, we see a very good opportunity in electrical utilities, particularly in the United States. We think there's three topics that are important. First of all, we think that utilities have performed very well because they are protected from a lot of the worries that we see in the market today. A lot of the uncertainty that has been brought by US policy does not apply to utilities, and that safety has really helped the shares perform. But also, there's a very strong growth driver in the sector. The demand for electricity continues to go up around the world, particularly in the United States, and that is driving strong and visible earnings growth for utilities. And the third point is that the valuations are still very attractive. This improvement in growth has not translated yet into earnings multiples. So that is making us very confident that this trend will continue. Well, if we look at the global macroeconomic context, and we think a bit about the policies that are happening in the US, there are things to worry about and there are positives. On the things to worry about, a lot of the uncertainty is driven around inflation, is driven around tariffs, and whether the economy will go into a recession or not. Those three worries do not really apply to utilities, because utilities are typically local businesses. They're not impacted by tariffs. Utilities operate in a certain state, they produce in the state, and they sell into the same state. So they have no impact from tariffs. When we think about inflation, we see that in the past, inflation has actually been a positive for utilities, not a negative. So that's also the reason why investors don't worry about it when they buy utility stocks. And then when we think about whether we go into a recession or not, electricity demand has always been non-cyclical. Whether we are in a good economy or in a bad economy, we still turn on the lights when we come home, and we still keep on using our electrical appliances. So the question of what the state of the economy is also less relevant for a utility investor. So a lot of the worries we're protected from when we invest in utilities. But there are also very positive aspects. The key cornerstone of the Trump policy is making the US economy grow again, reindustrializing the US economy, which means building more fabs, building more industrial plants, building more data centers in the US. All of those things need electricity. So that is a very big structural growth driver for the electrical industry that we think our companies can benefit from. As you know, we mainly invest in regulated utilities. And regulated utilities, by design, are protected from inflation. Costs are a pass-through for regulated utilities. When we look at the entire Gloin portfolio, 92% of our companies have inherent inflation protection. So when we worry about inflation, it doesn't impact them. And we can look in history. If we look over the last 20 to 30 years, there have been other periods where inflation was high, and utilities always performed well during those periods of time. And so actually looking at the last 12 months, we can look at how the earnings have evolved for utilities versus the overall market. And we can see that since the end of last year, the earnings expectations for the overall market have slowed down and actually started to slightly come down already, whereas over the same period, the earnings growth for utilities actually accelerated. That is demonstrating this lack of negative impact. But I also already talked about the positive impact. Donald Trump wants to reindustrialize the United States. And every day that we open the newspaper, there's an announcement somewhere of a company announcing a big investment plan in the United States. We can just pick out some. If we look at states like Georgia or like Texas, we see big investment plans from the likes of SoftBank, Hyundai, Amazon, Samsung. They're all investing tens of billions of dollars in those states in onshoring their local production. That is a very big positive for the utilities in those states. So actually, if we take a little step back and we look at the general consumption of electricity, there's something very interesting going on. If we look in periods by 20 years, between 1980 and 2000, the demand for electricity rose by about 2 to 3% per year. And then we hit the early 2000s, and that growth in demand has completely flatlined for 20 years. That was a period where the whole world was focused on energy conservation, using more efficient light bulbs, replacing light bulbs by LEDs, replacing freezers and fridges by more efficient ones, improving the insulation of housings so that we use less energy. But we've reached the limits of energy preservation. And everything that we're putting in place now is going towards the electrification of the economy. New technologies are coming up that all require electricity. Think about electric vehicles, for example. Think about AI and data centers and the amount of electricity that they consume. So because of that, since 2 or 3 years, we started to see a pickup in the electricity consumption again. And we can clearly see signs that that pickup is going to continue. So we think that we've just started a phase that is comparable to the 1980s, where we'll see 2, 3, 4% growth in electricity consumption per year. And that means that the industry needs to add capacity. And adding capacity is a very strong earnings drivers for our companies. If I just picked up one example of the ones I just mentioned, let's think about data centers. 5 years ago, data centers were very small and were immaterial in the greater scheme of things. But the emergence of AI has really jump-started the growth of this sector. If we look at all the data centers that are being built, by the time we reach 2035, the electricity demand for the entire data center industry is going to be of the size of the 4th largest economy in the world. So something that didn't exist 5 years ago is going to become a material driver of electricity demand in the future. We think that regulated utilities are very well placed to capitalize on this opportunity. As you know, regulated utilities drive their earnings by driving rate-based growth. So as they invest in CapEx, the CapEx goes into the rate base, they make a regulated return on that, and that drives earnings and dividends. So the bigger the CapEx, the bigger the rate-based growth, which ultimately leads into better earnings growth and dividend growth. And we've seen the inflection happening in front of our eyes. For the last 15 years, CapEx grew by about 4% per year in our sector. Since 2023, we've seen an inflection, and we're now seeing double-digit CapEx growth across the entire industry. And obviously, we've positioned Gloin to benefit from that phenomenon. So if you look at the CapEx outlook for the companies in our portfolio, 2 years ago, they expected to invest about $500 billion in additional capacity for generation and for networks. Today, 2 years later, that $500 billion have become $700 billion. So a significant step up in the growth opportunity for CapEx. And again, better CapEx means that the rate base will be bigger, and the bigger rate base at the same multiple will drive higher earnings. That's just the theory, but I can prove it by looking in the past. In the past, we've also seen periods where CapEx was high because new capacity needed to be built. If you think about the 1980s, for example, nuclear technology became popular, and utilities were building nuclear power plants around the world. It was a 15-year period where CapEx was high, and as you can see, share prices performed very strongly during that period. And then we hit a period where growth was a bit slower, and the earnings trend of utilities was a bit slower. And then we hit the emergence of shale gas in the early 2000s in the United States. It made the price of gas much cheaper, and therefore everybody was building gas-fired power plants. Again, a CapEx cycle that drove heavy investment, but that pushed up earnings and pushed up share prices. And then we've again hit a plateau after that. And now we've just started the next trend, where every company is investing into additional capacity to satisfy the growth in consumption, and in additional networks to connect all of those new plants. And so this is just the start of a cycle. We've always seen in the past that these cycles last for 5 to 10 years, and we're only a couple of years into this multi-year trend. So the attractiveness of the US regulated model is that it's capex-driven growth and not cyclical growth. And that means that the visibility is much higher than it is for the typical market. Because of all of the uncertainties that we see in the market, earnings for the global economy are starting to come in slightly below expectations, whereas the earnings trend for utilities is coming in exactly in line with expectations. But what's important as well is that the earnings today is much higher than it was before. Today, we're seeing about 10% earnings growth for the utility sector, and it comes with a very healthy dividend yield on top of it. So we're seeing strong earnings and strong dividend coverage for utilities that we're not seeing in the overall market. Actually, when you compare US utilities to European utilities, you see that the quality of those earnings are much higher in the US. European utilities have much more volatile growth because they're not regulated in nature. And the average growth level is lower. The dividend yield is higher, so it's showing that they're cheap, but they're cheap because they are riskier. In the US, on the other hand, we have very stable earnings. We have very attractive earnings at about 10% and a very attractive dividend yield on top of it. And what's then interesting is when we look at valuations, is that the market is not fully reflecting that stability yet. We see that the sector today is still trading at a discount to the overall market. And that shouldn't be the case. On average, in the history, utilities have traded more or less in line with the market. But that fluctuated between a 20% discount to the market when people were more focused on growth stocks, and a 20% premium to the market when people valued the security and the predictability of utilities. We're now coming out of a period where people were very focused on growth stocks and Magnificent Seven. And we see that because of the rise in uncertainty, people are more and more starting to value the safety in utilities. But we're still at a discount, so the trend has started, but there's a lot more to come. As you know, Gloin is a diversified portfolio of about 50 stocks. So we always try to find a right balance between the different types of companies. So let me just quickly introduce you 2 stocks in the portfolio. And it's 2 stocks that operate in very interesting states in the US. Southern, first of all, operates in the state of Georgia. Georgia is a state that attracts a lot of investments from foreign companies and where the demand for electricity is growing very strongly. Sempra is a company that operates in California and in Texas. Texas is actually the economy in the US that is growing the fastest, and where we expect to see a demand growth in electricity of nearly 80% in the coming years. The first one is called Southern. Southern is a US utility that operates in the state of Georgia. And I would call it a typical Gloin stock. Southern's been around for a very long time. Georgia has one of the best regulatory regimes in the US, which means that we have very high visibility on returns, and returns are attractive. Georgia makes about a 10% return on equity, which is amongst the higher ones in the US. And it translates into a very stable performance. If you look at the share price evolution of Southern since 2000, it has actually outperformed the Standard & Poor's. And if you look at the dividend composure of Southern, Southern's been paying dividends since 1948. And it's been raising its dividends nearly every year over that period. Actually, for the last 24 years, they've raised the dividend every single year. So that's why I would call a stock like Southern a real income stock. Real because it protects you against inflation. When you buy a government bond at 3.5%, you're exposed to inflation because the 3.5% will not be corrected for inflation over time. When you buy a stock like Southern, the dividend will grow in line with inflation. So your 3.5% yield that you get on Southern protects you against the negative impact from inflation. So the second stock is a very interesting one as well. The company is called Sempra. Sempra operates in California and in Texas, two very interesting states. But the problem is that the regulatory environment in Texas was not very supportive for investment. And that's where engagement becomes very important. As you know, a company, a fund like Gloin, with the assets we have and the experience and the connections we have, we can play a role in these things. And so we've been working together with Sempra, and we've been talking to the governor of the state of Texas and the regulators in Texas and trying to find a solution that would allow the company to invest more and in a way that benefits everybody, that benefits the people in the state of Texas because they need more generation capacity, but also allows the shareholders in Sempra to have an adequate return on their investments and adequate visibility on their investments. And so by talking together with all the stakeholders, I think we've managed to find a solution that is really a very good one for the long run. And it's allowed us to have a very attractive investment opportunity in Sempra. And so maybe if I can then round up, it's actually an honor to have been able to run Gloin for the last 20 years. And I would really like to thank you all for the confidence that you've put in our hands. As I explained, the portfolio has changed quite a bit and the world has changed quite a bit over the last 20 years. But the philosophy of Gloin has always stayed the same. We want to offer you a diversified portfolio that tries to find the right balance between stable capital returns and good attractive dividend income. And we always find opportunities somewhere in the world to build a portfolio that offers that to you. So it's been very enjoyable to run this portfolio for the last 20 years. And me and my team are very much looking forward to continue to do this for many, many years to come. Thank you very much.